Well, I'm joined now by Brian Coulton from Fitch, the ratings agency that spoke out this week and helped to trigger a slide in the pound. Brian, thanks very much for joining us. You had a pretty busy day yesterday. Were you expecting your words to have so much impact?
Not really, no. To be honest, it was more of a sort of preview of what the government might be doing in the June budget, but clearly it had a bigger impact than that.
Well, there's obviously a lot of nervousness around at the moment. I mean, David Cameron, very new to the job. He's saying all the right things. I mean, he's actually agreeing with what you said, isn't he, and saying that we need to cut it quickly. These are going to be the biggest cuts in a generation. Surely, so far, what do you think of what you've seen? You must be quite happy.
Well, it's clearly very encouraging. I mean, the mood music is all going in the right direction. I mean, I think what you have to remember is that investors and the market generally have given the UK a lot of the benefit of the doubt in terms of its widening of the deficit over the last 18 months.
And
or
then
so.
Because we've had this election, there's been a kind of a hiatus period where people haven't been looking
that kind of extended, extended that period a little bit. I think now with the budget, which is a very important fiscal event, and the comprehensive spending review in the autumn, it really is time to deliver. Otherwise, that benefit of the doubt may not persist.
Now, you used a phrase there, mood music. I mean, so far, the key thing is that we haven't seen what the actual cuts are going to be. And even with everything that George Osborne said yesterday, we don't have any more clarity into how much is going to come out of which department, apart from that $6 billion, which I think everyone agreed was a drop in the ocean. Is that what you're looking for?
Well, yeah, the $6 billion, as you say, which is about 0.4% of GDP. I mean, it's the fact that they're doing it this straight away, the fact that it's been articulated very clearly in terms of the precise departmental totals to go with that. I mean, that's clearly a strengthening relative to what we had before. But really, it's only the start of what's got to be a multi-year process of pretty deep cuts in our view. Probably at least as big, if not slightly larger than what we saw in previous consolidation episodes in the 70s and the early 90s in real terms.
Now, what you said clearly was that the budget as put forward by Alistair Darling in 2010, pre-election budget, didn't go far enough. Have you got in mind what you're looking for, what George Osborne needs to do to make sure that Britain keeps your AAA rating?
Well, one thing is improving the credibility of the planned cuts in terms of spelling out exactly how they're going to be achieved. That was always really sort of a missing page in the previous plans, how they're actually going to get there. But also, frankly, we think that it would be good for the government within the term of this Parliament, within the next 5 years, to reduce the deficit fast enough that the debt doesn't just stabilise right at the end; it actually starts to fall. Nearly every other government in Europe is aiming for 3%, either by 2012 or 2013. We're not even getting it to 3% by 2014 on the existing plans, the Budget 2010 plans.
And indeed, crucially, in the run-up to the general election, even when pushed, neither David Cameron nor George Osborne would say exactly how much they would like to cut the deficit by and what their plan is over the first term. Do you want to see a concrete number?
I think we do. I mean, we'll see that in the budget, but we do think a faster pace of deficit reduction over the medium term, not just in 2010-11, is going to be warranted in order to underpin confidence.
3%, is that good enough for you?
3% by 2014, because the path of the deficit to get there would be, if it was 1% GDP lower throughout, that would see the debt ratio to GDP peaking in 2012 and then falling. So we'd actually be achieving a stabilisation and a decline in the debt ratio. For us, that is quite important in terms of judging the government's ambition. If we just about get to debt stabilisation right at the end of the 5-year period, based on arguably optimistic growth assumptions, which were in the budget, and a lack of detail, that for us was a concern, frankly.
And that's not going to be enough to keep a AAA rating?
If we end up sort of exactly where we were before, I think we would have some concerns.
The danger, of course, is that other voices are saying this is going to lead to a double-dip recession. You're choking off the economy. These just aren't the right things to do. Is cutting the deficit your only marker here?
No, obviously, I focused on the ratio of debt to GDP, and what happens to GDP is obviously important for that. And if you drive the economy into a sort of massive recession, deflation, that's actually going to make the situation worse. But we don't think this path that we've set out would do that. I mean, frankly, the time for that debate was sort of 2008, 2009. And moving on, the bigger risk now is that you don't move fast enough, and you get an economy-wide interest rate shock.
Now, these cuts, David Cameron's been preparing the British public for them as much as he can. Nothing like the 15 months that Canada had to be prepared for the kind of cuts that they had. We've seen what's happened in Greece. We've also seen what's happened in Spain. Is there a concern? How much do you look at how painful this is for people and how much they react?
I mean, obviously, there's one thing having a plan, there's another thing implementing it, and obviously, the political issue is something that we're concerned about in Greece, for instance, and the implementation of their plan. The plan itself is strong in Greece, but whether they can see that year in, year out is obviously an issue. But we'll look back at the UK; it's been done before. The UK economy, has grown pretty rapidly in the past when there's been fiscal consolidation. Frankly, we think the bigger risk is not being seen to be done enough, because then we'll have interest rates going up across the economy. And don't underestimate how important low interest rates have been for this recovery.
OK, Brian Coulton from Fitch, thank you very much indeed for coming in and sharing your thoughts with us today.